Okay, we want to continue with the case study. Quiet, please. Okay, so the point is we have the firm has I think I talked about that. So the first thing when you do an investment making process is you need to find out what are the investment opportunities. And the investment opportunity set is also a jargon term if you want, but people know what it stands for. It stands for the expected return, the vol, and the correlation of all the risky assets. And the risk-free rate, I would say. Okay, now in the case study, that information is given here. Yeah, we have asset class, US equity, foreign long-term bonds, volatility, the risk-free rate I did set to 0 by definition. Risk-free rate has no vol. In the case, its the rate is 3.2%. Now we have long-term bonds. So I kind of don't go through all numbers, but these are the metrics. You can get that from the case. Now, first thing I do compute is the risk premium. So I simply subtract the risk-free rate from everything. The next thing I do is I compute the Sharpe ratios. Yellow highlight is highlighted by me. It means it's my flag. Yeah. So first thing you see could happen in any data science application. Two numbers are the same. We know probability-wise the probability 0 that something is the same. So you can check in a case. I think if you do some. I think my point is the Sharpe ratio is 0.64. They are both 0.64. Bond has 0.2 Sharpe ratio, so equity higher Sharpe ratio. It's intuitive. The rationale of why US and foreign equity has the same Sharpe ratio is something a data scientist should then go back to the tables and try to figure out. Every table, be it in your academic thesis or in a table that someone gives to you, you should make sure it's clear to you where the numbers are from and how they are computed. So it's a good exercise for you to double check that. Usually that's in the caption of a table or in the text talking about the table. Okay, but in that case, we just go for it right now. 0.64 are the Sharpe ratios. Anyone remembers the rule of thumb from last class? What's the Sharpe ratio of the market unconditionally last 100 years? Okay, maybe you double check. And then we have the correlation matrix here. I also take it from the case. So we see here US equity, foreign equity has a 0.62 correlation. And we see that the bonds have a 0.25 with equity 0.06. So again, like in any data science thing, you have a black boxy thing in the middle and you want to understand the data in order to understand how data affects your output. And that's what I'm doing here with the yellow marks. I kind of see that the Sharpe ratios are higher for equity. So all else equal, equity will be dominant relative to the bond in the tangency portfolio. I also see Sharpe ratios are the same, equity wise, so all else equal, both parts of equity will have the same share. And now I see that the bond has a low correlation, relatively low. How do I know relatively low? Because I see 0.6 is equity with equity. So this is a third of it. And I see that foreign equity has a even lower correlation. So all else equal, it's going to tell me that first, the bond will be the diversifying asset. So it will be part of the tangency portfolio. Why? It will reduce risk. I see that only from the correlation matrix. There was a student coming up. I have the question again. Keep in mind, correlation, covariance, it's all about co-movements of the unpredictable parts. So it's the realized value minus the mean multiplied by the realized value of the other variable times minus its mean, and then the expectation out of it, if you go for covariance. Yeah? So therefore low correlation means the unpredictable parts have a low correlation with each other. So bonds have a purpose here, I see that. And I also see that bonds and foreign equity has a 0.6 correlation. So all else equal, this will tell me that foreign equity is preferred to US equity, because it has the same Sharpe ratio that's input to the problem, but bonds and foreign equity diversify each other better than if I use US equity. So I don't need to wait for Markowitz to come around to already see. I can't put a number on it, but kind of like relative statics, I already know foreign equity is my Sharpe ratio asset, which will be it's the premium asset, which the optimizer will like. And it will like it because same Sharpe ratio than US equity, larger than bonds, and it has this low correlation with bonds. So that we can check later in the solution. It needs to show up because the input I've been characterizing is the one given in the case. Good. So these are the interpretations. I've just mentioned that. So many things I mention are on the slides later on, yeah, for you, for your review. Here's the interpretation of covariance. I've done it. I do it again because there have been students in the past who have the question, if something is perfectly negatively correlated, does this mean my expected return is also zero? Yeah, the question can really come up. Therefore, I have an example here. We have a 0.62 correlation between US and foreign equity. It means the following. It means that if equity earns 1% less than expected, so instead of 12.94 expectation, I earn 1% less, it would mean that foreign equity tends, because it's the expectation of the second moment, yeah? So it tends to earn 0.6% less than expected. So you therefore see if you had a negative correlation, if the correlation was -1, in this example, it would mean if US equity was to earn 1% less than expected, foreign equity would earn 1% more than expected. And that's perfect diversification, which in this case doesn't exist because the correlation is only 0.62. But this is to keep in mind that the correlation is between the unpredictable parts. Okay, so bond has a correlation of 0.25 with US equity and 0.06 with foreign equity. So if we add long-term bonds into an equity portfolio, it will diversify a lot of equity risk. So I've mentioned that, but I have it on the slide here once again. So I like in the case several things, and one thing is to really see, although the expected return of a bond is so low, it will be optimal to have it as part of your final asset allocation, and the reason are these low correlations. And the numbers are kind of realistic. Good. Now what do we need to do? In the case, we need to determine first, was the current LTP of Partners Healthcare a good, risky portfolio? And now we have some analytics on our side that we can use to solve this problem. The analytics we use is the Markowitz approach, because Markowitz tells us that a good portfolio for LTP has the highest Sharpe ratio. So we can therefore very simplistically check whether the Sharpe ratio of the LTP is somewhere in the area of the Sharpe ratio of the tangency portfolio. And if it's very close to each other, then it's a good portfolio. If it's very far away, LTP would not be a good optimal risky portfolio. So that's what I've been doing here. I look at my asset classes. I have now expected return, the volatility, sigma, and the Sharpe ratio. I compute here I have here the portfolio holdings. They are given in the case. So LTP I think if you go back to the very first slide on the case, you see these portfolio holdings in case you want to double check, but you don't have to. I checked once. So you have 55% was invested in US equity, 30 in foreign equity, 15 in long-term bonds. So the resulting average return is here kind of the sample return, over the past years for which the analysis has been run. It was 11.65%, the vol 11.98%. So if I compute the Sharpe ratio, it is 0.7. I should have put the risk-free rate here for completeness. I don't know, maybe it's coming up. Just realize it now. So, but the important thing is we now compare to Markowitz. The mean variance solution for Markowitz gives me the following. I should invest 40% in US equity, 47% in foreign equity, bonds 12, the expected return vol in the Sharpe ratio is 0.71 here. So there are a few messages. Again, what I say now is on the next slides as well, but I like just to do my thinking here. First, I see that, or first, how did I compute that? I used a Markowitz optimizer. You are going to program one yourself later on. Here I used some Excel tool. You will use Python. So the solution is here only for the tangency portfolio. So I just need to know among all the risky assets, what is the combination with the highest Sharpe ratio? I found it. Now, is now the LTP close to Markowitz? That is the question. Well, it depends. Why does it depend? Because if we look at the portfolio holdings, it's different. We see that US equity should be lowered to the benefit of foreign equity. The rationale is exactly what I saw and highlighted. It's coming from the input data. That's a typical thing, yeah? You have input data, then you have a deterministic algorithm, you got the output. So if something is different in the output, it has to do with the input data. And we saw foreign equity has a 6% correlation with bonds and the same Sharpe ratio than equity US. The US equity has a 25% correlation. Therefore, all else equal, if you put more into foreign equity, you can diversify more without losing Sharpe ratios relative to US equity. Jargon-wise, this is called home bias. So it's known in psychology research, financial psychology, that a US investor prefers to invest in US equity. Most likely your relatives will have a German home bias. Maybe not, then it's good. So that is just a footnote inside the case. But are they different? Markowitz says a tangency portfolio, or the tangency portfolio, is the portfolio with the highest Sharpe ratio. Therefore, yes, we see here that the Markowitz tangency portfolio has a higher Sharpe ratio. But 0.7 versus 0.71 is pretty much the same. Yeah, this is, I've experienced, especially for bachelor students who are in this field the first time, they are used to look at the last digits after the comma. In finance, we don't do that. There we are a bit more generous, because we know of estimation error, input data error, and all the like, and we know about transaction costs. So for us, the LTP was a very good portfolio. It was very close to the optimum. That's the punchline. On the second order, I can say what I said before, the allocation is different, but interestingly, without much of impact on to the Sharpe ratio, and I gave you 2 times the reason for that. So they did a good job. That's the baseline. Okay, this is all the interpretation I've been doing. If you want to rework that at home, I have some text here. Now the next problem in the case is Could they do even better if they started to diversify into REITs? So REITs, think about that, it's like an ETF on real estate, commercial real estate usually. Yeah. So, and or what happens if to their portfolio allocation if they were to invest into commodities like gold, pork, soybeans, whatever, forest, maybe even crypto, although it's not a commodity, but anything alternative here a little bit. Okay, so inside the case, the input data is given to you. So what's the input data? We need to know expected return and covariance matrix. So here I've been condensing information in terms of Sharpe ratio and correlation. And we see here that REITs have a Sharpe ratio of 0.46, commodities have a Sharpe ratio of 0.37. So all else equal, I see that REITs will steepen or has a steeper Sharpe ratio or a steeper slope if I simply look at risk premium per unit of volatility between REITs and commodities. So all else equal, I see that REITs are attractive. And I don't care that it's called REITs, right? Once I'm at that level here, I just care about the statistical properties, just to exaggerate my point, that the input are now the statistical quantities and they will decide how much to invest into. It's not the name anymore. Yeah, but okay, for the sake of the case, so REITs is attractive relative to commodities because higher Sharpe ratio. But we learned already from long-term bonds in the case, the correlation is important because the lower the correlation, the more diversification, the steeper the capital allocation line, the better for all investors. And here we see, I picked out one number to highlight the argument that the correlation with US equity is 0.6, which it's not spectacular because foreign equity has a 0.6 correlation and has a higher Sharpe ratio. So I can already see that REITs are a bit of a lame duck now in that thinking once I go multidimensional because it gets dominated by foreign equity. But on the other hand, commodities is interesting because it has a negative correlation. So it dominates now long-term bonds as a diversifier, and it has a higher Sharpe ratio than the bond. So I can really see now that commodities are the asset that will make the capital allocation line be steeper. Right? So before even running the analysis, I can see that commodities must have a big share. How much? I don't know. I don't know. The calculus I can't do in my head. But I see it dominates REITs, and it's interesting to see whether it will dominate one of the equities because it's competitive with the 0.37, although it's half the Sharpe ratio. So that we can't put numbers on it, but we see commodities is the thing to invest into most likely. So here I'm giving you the final allocation. So I've been using, again, a Markowitz optimizer, and I've been just interested in the tangency portfolio. And here's the allocation. 24 equity, it used to be 44. Right, so that's the old one, 44, 47, 12. Now it's 24. Equity foreign is a bit larger for the same reasons mentioned before. Bonds are reduced by half. And you see commodities will be 24. So really competitive. So it will be basically sharing with US equity the second spot. And foreign equity is the first. The Sharpe ratio in REITs is 10% roughly. The Sharpe ratio goes up by 0.8. So 0.7 was the status quo. Now it's 0.8. So it's an increase of roughly 15%, relatively speaking. Yeah, from 70 to 81, roughly 15% relative increase. That is considerate, something to consider. We can't give standard errors and the like here, but you see my argumentation would be nice to have. We also see REITs have a share in the portfolio, but it's dominated by commodities. We gave the reasons already when looking at the input data. It's something for you to take away for your own life, because for sure, you, the way like I'm tempted to look at what's the expected return of an asset, because it's more difficult to think about how much does it diversify my existing portfolio. But here you have now a second example where the diversifying asset has a high share just because it has a low correlation. And I try always to do that with my own investments. I always try to quantify in my head, in simple terms, do I think there is diversification happening with the extra asset? And if so, I try to figure out how large is it, and I just need categories: large, middle, low. And if for some reason it's large and I really want to diversify, then I'm more inclined to buy it, even though I know expected returns are basically zero in my rule of thumb calculations, which I do myself. Okay. So therefore, coming back to the case, yes, in the case it would be beneficial to add REITs and commodities. We would increase the Sharpe ratio. The capital allocation line would get steeper by 15%, relatively speaking, to the status quo. That would be to the benefit of all the hospitals, independent of their risk aversion. So yes, they should do it. Now, another thing I've been interested in has been to quantify which of the two alternative assets is the one to invest into if I could invest only into one. We know already it's the commodity. I argued for it and we saw it in the 9% versus 24% share. What I'm now doing is I want to compute the tangency portfolio according to Markowitz if I can only invest in LTP plus REITs or LTP plus commodity. And the interesting thing is, if I directly jump at what's key, right? And we had it already in the case, the allocation is not so much key, it's a Sharpe ratio that comes out of it. And I see that 0.811 is the Sharpe ratio I get if I leave REITs completely out. And the optimal solution was 0.816. So again, this is indistinguishable from a practical point of view. So one could recommend, if they are really a bit nervous about expanding into REITs versus commodities, to simply just go into commodities. The case is too strong for it, while the case for REITs is rather weak. Again, conditional on expected returns, and correlations and covariance matrix are the ones that the case gives us. And if you do LTP plus REITs, you see the Sharpe ratio goes to 0.72. And the original one in LTP was 0.71. So it would increase again a little bit. Again, the typical bachelor students would say, yeah, that's a big improvement. I want to highlight for you. That's not a big increase. 0.7, 0.72. Considering all the risks in the market, that the input numbers are wrong most likely, and transaction costs, and you need to find managers who do that, which is costly and the like. REITs don't do it basically here, yeah? Although strictly speaking they do. So that's kind of interesting, I hope also for you, to really see that the improvement in the Sharpe ratio is really coming here from the diversifying asset, the commodity. So maybe the next interesting thing for me would be volatility. If I just look at LTP, 11 versus 10 are the coordinates for expected return vol, and here it's 12 versus 12. Okay, but it doesn't matter. It's the Sharpe ratio which we care about. Right, in terms of holdings, just wonder what is the proxy then for REITs if I leave REITs out here. Bonds is roughly the same at 10. Yeah, we just see that it will increase US foreign equity 24-30 if I have REITs in. If I have REITs out, it's increasing equity a little bit. So it goes for the higher Sharpe ratio assets, while the diversification, which comes from commodities, is roughly unchanged at 25-24. Yeah, so you really kind of see that the diversifier has its own place. And as an anecdote, it's very typical if you create your own hedge fund and you go and you're pitching it to the industry, your pitch will look like you have a great idea, you have great evidence, and importantly, the returns you generate are negatively correlated with the market. Right? If you can't show that, then most likely it will not work for you guys. Because the market, the investors are thinking like in that case here, and that's what I want to bring across to you, so that you can also think in these terms. Right? And the terms would be, for this anecdote, investors, they have already their big asset managers and they have already their big allocation. If anything, they would be interested to invest a fraction of their funds, like here with the REITs, commodities, into some new idea. But that new idea, best case, has a negative correlation or a zero correlation with the existing. You don't know what's the existing allocation, so therefore you proxy that with the market, and even has a high Sharpe ratio. But just having a high Sharpe ratio and a correlation of 1 in the extreme case will be very unattractive to the other investors, unless the Sharpe ratio is ridiculously high, which is questionable, but if you could do that. The safer strategy is to make sure that the strategy that you backtest and then present has that negative correlation with the market. Then it's a diversifying instrument what you offer, and at the same time with modern machine learning and the like, ideally has high Sharpe ratios. So it has two benefits. But all else equal, you see that the diversifying benefit is really important. And as another rule of thumb, I mentioned that today already once, now again for you, it's very difficult to find instruments that have a negative correlation. Yeah? So typical things with low correlation, you would think about the DAX versus the S&P, that's the market, and now what could have a negative correlation or a low correlation? It's bonds, as we have in the case. It could be like gold, because gold goes up when the market drops. People argue cryptocurrency. You have to check, but there's evidence for it. Someone else, some other, which I read. So you kind of see these are the typical the typical examples for low correlation instruments. Therefore, if you come up with your own fund that has a low correlation, it will be very appealing to a vast amount of investors. Good. Now, coming back to the other question in the case, is there a one-size-fits-all solution for LTP? Yes, there is. We now went through all of the Markowitz, so we know there's a unique tangency portfolio, highest Sharpe ratio, steepest capital allocation line. That's the LTP that the partner healthcare should be using. We saw it can be improved if we add these two additional asset classes. We saw commodities as the biggest benefit of if we had to choose between these two. And now here's an example now how it could look like for a hospital. Now in practice, the hospital will not tell you risk aversion, right? They don't know what they should do with that concept. So you do instead, you ask either for what's the risk you want to take or what's the expected return. So the last is easier to visualize. Yeah? So you say, what's your expected return? And here I assume the hospital says, I would like to have 10% on average. Okay. Now, I know that my new LTP is going to earn 10.92%. Let's double check where the number is from. It's here. So I know that the hospital will be on the capital allocation line. It's a straight line. So therefore, the expected return will be a linear combination of the LTP plus 1 minus y times the risk-free rate. The hospital wants 10% on average, and therefore I can compute the amount of, or the share of investment for a hospital that ends up with 10%, and it should be here 88%. So we can double check. The expected return on the hospital would be 88% times the expected return of our LTP plus 1 minus 88 is 12, so plus 12% times the return on the risk-free rate, which indeed adds up to 10%. Right? So the customer hospital just says 10%, and then the asset allocator can directly compute the resulting portfolio allocation because it has the TP holdings, the new ones here. And now it knows y equals 88%. So it would take, if the hospital wants to invest 100 million, so it would take 12 million into the risk-free rate, which is the STP fund, and 88 millions into the new LTP. And these 88 millions would then be allocated 24% US equity, 30% foreign equity, and the like. And the hospital will just have a piece of paper saying you have an optimal portfolio. We did allocate your funds such that your expected return of 10% is matched. Okay. Now let's have an extreme case. If the hospital wants 20%, then we have 20% is the target. It can be accomplished. We move along the allocation line. So it's y times 10.92% plus 1 minus y risk-free rate. We solve for y, and we see the solution is 2.18. So it would be 218%. So intuitively, it means 200%, 218% goes into the LTP, and 1 minus y, so it's 1 minus 2.18 is minus 1.18, minus 118% risk-free rate. So if the hospital wants 20%, it wants to invest, let's say, 100 million, we could offer 20% in expectation, but for the 100 million it wants to invest, it needs to borrow an additional 118 million, so that we have, as an asset manager, 218 million. And now these 218 we would invest in LTP. And you kind of see this is now a leveraged portfolio. Yeah, that is something that a hedge fund is doing, but not a hospital. So therefore, simply such a high expected return, given the capital allocation line in the market, is unrealistic. We could do it, but I think the hospital, once it sees these numbers, would understand then that having a target return above the LTP would imply shorting, not the market, but shorting the risk-free rate, so kind of take up an extra loan for the investment, and I would assume the hospitals don't do that. Yeah, but here's the interpretation. I gave you the interpretation, and at home you could go if you want to. Maybe we do it here, it's interesting. Let's just double check that the hospital gets 20%, and it's good for you to see how this shorting comes in. So the 100 million is the equity of the hospital. If the optimal solution is 2.18 LTP, it means another 118 million needs to be taken as debt. Therefore, we take the sum of both, 218, and we are investing it into the LTP, which gives us 10.92%. So we would make 241 million in expectation. We are borrowing 118 at the cost of the risk-free rate by assumption. So we have costs, annual costs of 121 million. Therefore, revenue minus cost give us 120 million kind of net income. And if we now divide the 120 million by equity, or here I do 120 minus equity divided by equity, I get my 20%. Yeah, so we can really make 20% on it in expectation, but it requires us to take a big short position in the short-term fund. And there's the punchline: the hospital is not in the business of running these leveraged portfolios, so the advice would be to lower the target return, since the market environment currently is not offering such opportunities. Okay, you could redo these calculations and go via the variance, because the variance is also linear. Yeah, maybe you want to practice that at home. That's another way. And for me, the variance is also kind of intuitive, because if someone asks me for expected return, I'm inclined to say 1,000%. Right? Why not? But if someone asks me for variance or volatility, then I'm thinking more carefully. Yeah? I'm thinking really about what could I lose, what am I willing to lose in the worst case. And for us, it's nice to use now the allocation line. Variance is additive, and we can also solve for it. Yeah, but I don't have it on the slides. Oh, I see. That's my last slide.